Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Healthcare Realty Trust Incorporated Annual Report. Healthcare Realty is a leading real estate investment trust, REIT, that specializes in owning and operating medical outpatient buildings. The company's portfolio consists of 579 properties located across 28 states, totaling 33.6 million square feet. These properties are strategically situated around market-leading hospital campuses, providing a unique opportunity for healthcare providers to expand their services. The company's business model is centered on property acquisition and development, allowing it to selectively grow its portfolio and increase its value. With an enterprise value of approximately $11.1 billion, Healthcare Realty has established itself as a major player in the healthcare real estate sector. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to increase. The stock price of Healthcare Realty Trust Inc. has increased slightly over the past year due to several factors. One major reason is the company's strong financial performance. With a steady stream of rental income from its portfolio of healthcare properties, Healthcare Realty Trust has been able to maintain a stable cash flow and pay consistent dividends to its shareholders. Another factor contributing to the increase in stock price is the growing demand for healthcare services. The aging population and an increasing focus on preventive care have led to a surge in demand for medical facilities, making it an attractive investment opportunity for Healthcare Realty Trust. Additionally, the company's strategic investments in new properties and redevelopment projects have also contributed to its growth. By expanding its portfolio and improving existing assets, Healthcare Realty Trust has been able to increase its revenue and enhance its value proposition to investors. Lastly, the overall market conditions and investor sentiment have also played a role in the slight increase in stock price. As the economy continues to recover from the pandemic, investors are becoming more optimistic about the prospects of healthcare-related stocks, including Healthcare Realty Trust Inc. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company are multifaceted and influenced by various financial performance indicators. On the growth side, the issuance of common stock, conversion of OP units to common stock, rental income from non-cancelable leases, and parking revenue and management fee income have been significant contributors. These factors have collectively contributed to an increase in revenue. On the other hand, shares repurchased, dividends declared, impairment charges, and changes in holding periods or property use have led to a decline in revenue. The impact of these drivers can be seen in the company's ordinary income and capital gain figures, which have fluctuated over the years. Furthermore, segment expenses such as property taxes and utilities have also played a role in shaping the company's financial performance. Overall, understanding the primary drivers of revenue growth or decline is crucial for investors and stakeholders to make informed decisions about the company's future prospects. By analyzing these factors, they can gain insights into the company's strengths and weaknesses, enabling them to anticipate potential trends and make strategic investments accordingly. Net income and profit margins. A changing landscape, the net income of a company underwent significant fluctuations between 2023 and 2025. Initially, the company experienced a decrease from $1,232,776 in 2024 to $1,138,056 in 2025, indicating a decline in profitability. However, this trend reversed in 2025, with the net income decreasing from a loss of $281,616 in 2023 to a loss of $248,481, suggesting an improvement. Profit margins also underwent changes during this period. While some debt instruments experienced increased profit margins, such as senior notes and unsecured term loan, others saw a decline, including mortgage notes payable. The company's capital expenditures as a percentage of cash net operating income decreased from 4.1% to 4.8%, while leasing commissions as a percentage of total cash net operating income increased from 6% to 7.5%. Furthermore, the FFO margin decreased from 0.52 in 2024 to 1.38 in 2025, but normalized FFO margin increased from 1.56 in 2024 to 1.61 in 2025. The changes in net income and profit margins can be attributed to various factors, including a significant decrease in revenue, increase in expenses, impairment of real estate properties and goodwill, and changes in government healthcare programs and regulations. These factors have contributed to the fluctuations in the company's financial performance over this period. The company's financial performance indicates a consistent generation of positive operating cash flow. This is evident from various sources, including net cash provided by operating activities, which shows a significant positive number on page 1. Additionally, cash flows provided by operating activities for the 2 years ended December 31, 2025 and 2024 were substantial, with $457.1 million in 2025 and $501.6 million in 2024. Furthermore, FFO, funds from operations, attributable to common stockholders, was positive in both 2025, $490,048, and 2023, $547,126, indicating a strong operating performance. The same-store cash NOI for the years ended December 31 also showed positive results, with $601,925 in 2025 and $573,072 in 2024. The company's ability to generate cash from its operations is further supported by the cash NOI figures, which were $731,611 in 2025 and $781,333 in 2024. The operating cash flow summary on page 78 also confirms positive operating cash flow in all 3 years. Finally, interest income and income from lease finance receivables indicate a strong financial position, further supporting the conclusion that the company is generating positive operating cash flow. The company's financial situation has undergone significant changes in recent years. A review of the extracted summaries reveals that the company's debt level has increased substantially. The total debt outstanding rose by $186,766 from $3,911,423 to $4,098,189. This increase is evident across multiple pages, including page 43 and page 102. However, there was a notable decrease in the carrying value of senior notes and mortgage notes payable, amounting to $751.4 million. In contrast to the rising debt level, the company's interest expenses have decreased. The change in interest expense saw a significant drop of $33,436,000 from 2024 to 2025. Furthermore, interest paid has also decreased, falling from $202,503 in 2024 to $176,550 in 2025. Despite this, there was an increase in interest expense due to reclassification from accumulated other comprehensive income, loss, related to settled interest rate swaps, amounting to $1,043. Management's outlook for the company is optimistic, with a focus on creating long-term value for all stakeholders. The goal is to provide well-operated facilities that enable healthcare professionals to deliver high-quality care in desirable outpatient settings. To achieve this, management will oversee the implementation of the company's environmental, social, and governance (ESG) principles through the board of directors and incentive programs. The company is well positioned to benefit from the shift towards outpatient services, with a diversified portfolio of properties that can navigate potential economic downturns. Management expects to generate strong cash flows from operations, which will be used to invest in new opportunities, pay down debt, and return capital to shareholders. The growth plans rely heavily on development and redevelopment of properties. Management is also focused on maintaining access to capital through the unsecured credit facility and continuing to grow the business. However, there are some challenges ahead, including reletting properties after Hartford Health assumed some of the leases. Despite this, management believes that its leases mitigate the impact of inflation due to fixed base rent increases and consumer price index-based rent increases. Overall, management's strategy is centered around creating long-term value for stakeholders while navigating potential challenges in the healthcare industry. By focusing on ESG principles, generating strong cash flows, and investing in new opportunities, the company is well positioned for growth and success. The company has made several significant acquisitions and divestitures over the past year. In terms of acquisitions, the company has entered into joint ventures with unrelated third parties, acquiring 61 properties in the process. Additionally, the company acquired Prospect Medical, an 80,912 square foot property, from Hartford Health in October 2025. The company has also made several divestitures, including the sale of held-for-sale properties and a real estate property in Houston, Texas. In March 2025, the company sold this property for $5.4 million through seller financing, while in December 2025, it was sold again for $6.4 million through seller financing. Furthermore, the company has divested 70 properties in 2025, with sales prices totaling approximately $1.1 billion and net cash proceeds of around $1 billion. The Prospect Medical assets associated with the company's Prospect leases were also sold to a subsidiary of Hartford Health in October 2025. Finally, the company disposed of one property in Texas in 2024, resulting in a loss of up to $16,729. The company has demonstrated its commitment to returning value to shareholders through two key initiatives. Firstly, it has paid dividends, with multiple references throughout the document confirming this practice. This indicates that the company prioritizes rewarding its investors and stakeholders. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, it repurchased 2.9 million shares in January 2026 for a total of $50 million. This strategic move allows the company to reduce its outstanding share count and potentially boost earnings per share. There are concerns about inventory buildup and supply chain disruption. The possibility of supply chain constraints arising from a pandemic poses a significant threat to the smooth operation of businesses. This is highlighted in the document, specifically on page 15, where it mentions supply chain constraints as a potential issue. The impact of such disruptions can be far-reaching, affecting not only the companies involved but also their customers and the broader economy. It is essential for businesses to be aware of these risks and take proactive steps to mitigate them, ensuring that they are prepared to adapt to any changes in the supply chain. That concludes the financial summary for Healthcare Realty Trust Incorporated. Feel free to comment below, and I will be happy to answer them when possible.